Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead. Good evening, Rob. How's everything this week?
Hey, great. I'm glad we're hitting this thing again on a Saturday because we've heard some feedback from people that they really appreciate getting it ahead of time and being able to use it for preparing. Just a reminder, listeners, that Sunday night futures, they open at 6 p.m. on New York time, and monitor that evening session as well as what happens the next day, because it can be different. Things can change before the open on Monday. But it can give you a little bit of indication of how things might play out. So it's good to observe, and good to observe also the change that happens the next morning, both on the futures as well as the sector ETFs and so on. So we'll get started here with we've got last 5 days of July's seasonality for ETFs. What leaps out at you there off this screen?
Yeah, the first thing is that
Dave?
number on the bottom, 82% there. So it's a really robust last 5 days. And even the final day is expected to be up, which is usually a down day for most months. So it's kind of a robust 5-day seasonality. And within that, it's showing gold and silver being very strong, real estate, oil, utilities. And some of the things that are weaker are the higher beta stuff, the ARK KK funds, XBI, so biotech, and XLC. So that, coupled with some of the earnings and the big mega caps this week, is going to kind of lead the way there.
Right. Well, I mean, it starts on Tuesday, right? Tuesday is the beginning of the 5-day window, right?
Correct.
So we've got a 1 day, kind of a pause and reflect day, and then also we have FOMC this week. Now, is it possible that that interferes with maybe the prospects for gold or utilities, because utilities have an interest rate component? Energy might also be sensitive.
Well, there's a quarter point raise baked in already to the numbers. So if they were to go 0.5% or something, so that could derail the rally.
Right. Well, I also find that historically we tend to be a bit more, bullish ahead of an announcement. Even if the market's expecting there to be a raise, it's just, I don't know what it is. It's just something about investors' attitudes as they're waiting for the FOMC. It just seems to be slightly bullish, and you would think it would be completely pause and reflect and wait or whatever, but it actually does tend to rally a bit on the Tuesday before a Wednesday announcement, and even a bit in the morning or especially the half hour before the announcement. So anyway, that's what we've experienced over the years. So this is important to reflect on. This is quite a bullish 5-day window, and this is the stocks. So part of the reason this might be changing here, and it's a little bit different than the ETFs, is because of how many stocks you're pulling in, as well as this does not include like inverse relationships like on the previous ETF has a few inverse relationships there too that are being shown. So that's what's different, but still very, very bullish. And what kind of leaps out at you here in relationship to the sectors that they're in?
I see a lot of solar stocks, Enphase for solar, Sunrun. Those kind of stocks are expected to do really well. And again, your ARK KK things are weaker. Roku, Twilio, Teladoc, those are weaker. Some of the Chinese ones too, Baba, Baidu, Intel. So again, I think bigger NASDAQ kind of stuff within tech is doing better. And even basic materials like steel, X and Cleveland Cliffs.
Right, yeah, exactly. That kind of aligns with the GDX and GDXJ and stuff too. Okay, good to note. So what Dave is suggesting is looking at the ETFs for that general context, that backdrop, and then finding symbols that are within those groups for supporting your long and short side accordingly. So makes good sense. And just a reminder how this calendar works here. Anything with odds over 50 means it's more probable that it's moving by that average percentage. So like when you get up to, you know, 75, that's probably a good sweet spot. If you get to 100, there's probably not a lot of samples. You can go to the actual calendar, which we're not on. We're just on a snapshot of it, but you can put mouse over and see how many events are within that, because nothing, usually nothing has a 100% guarantee of moving that direction, even if it says 100. That just means in the past number of years related to July's seasonality here, that has been bullish, you know, every time. So how many times is that? Well, we have 5 events, so that means that all 5 events have been bullish. But you can mouse over that and see, has it only been around for 5 years, or has it been around for all 8? A sample of 8 is going to be greater than a sample of 5 for sure. Moving on here to sector performance, this is what we experienced on Friday here. Is all of a sudden utilities had a pretty good session. Now Friday was an inside day; it was trading inside the range of Thursday, and Thursday was a bit of a down session, kind of pulling back from the highs on Wednesday. And so utilities sprung to life there on Friday. Healthcare. So again, these are in the more defensive category. And then technology and communication services are more in the risk on category, and consumer cyclical. So this kind of shows that the defensive side was dominating more over the risk on side, or the discretionary side. And for the week, we had energy kind of come roaring back, and it's not often that you see energy on top for the week. It's certainly not so far this year. So that was interesting to see. Healthcare next, financials. Financials have been pretty strong ever since sort of the stress tests on the banks. And, I think a lot of people were expecting there still to be more problems to come with the banks and financials, and it really hasn't played out yet anyway. Communication services, can be dominated by, the Googles and the Meta and stuff like that. And cyclical can be dominated by, the Amazon and Tesla area. So let's look at the map of the market as well. Let's pop it up here. S&P. I want to look at the whole week here. This gives you a pretty good picture. So this is the 1 week performance. And again, you see communication services, you see consumer cyclical, and look at the green spots. Look at the big banks, more so than the credit card processors. The big banks were very strong, energy very strong. Of course, Exxon is such a big part of that. Chevron, utilities, pretty coming in pretty good for the week. Healthcare as well. So what we see from this is a more broad market, strength, and not sort of dominated just by a handful of the, mega caps. Part of the reason was we had rebalancing in the NASDAQ. So there's been some change in the, software related to the weight of these mega caps going forward. So that kind of put some softness into them, and they've had a pretty good run for the year, right? So all things considered, if Tesla's down 7% for 7.5% for the week, well, I mean, that's not much compared to how much it's run with this year already. I mean, we can go year-to-date performance. Well, there you go, right? 111% for Tesla after it declined this week. So keep things in perspective. We've had some amazing runs on the tech area. Granted, if Amazon was down, 50% last year, let's say, I mean, it still isn't back to where it started. So with percentages, you have to, double it to get back to where you started on the upside. So, but nevertheless, really great performance. And healthcare had a pretty good week, but for the year to date so far, it hasn't been doing that well. And same thing with energy. So again, really good to keep yourself up to speed by looking at all time frames. So back to our slide here. This was the groups and market sector performance. So for the week, again, this is a broader market, not just the sector spiders. The sector spiders are down here. So for example, XLB. So for the week on the broader market, 0.46, but for just the sector ETF, 0.59. And let's see what like basic material, or sorry, consumer staples. We had consumer defensive was 1.42, but the XLP itself was 1.82. So obviously something's holding back the larger sample in the sector, whereas just the sector spider, the S&P related sectors, that's down here. Now the diamonds came in at 2% for the week. Russell 1.53. Qs were down 0.91, again largely affected by that rebalance and mega caps. And then the SPY 0.65. Okay, and then you have your inverse Qs and your inverse SPYs, right? Just remember on any of your inverse or your leveraged ETFs that they don't perform exactly to the index. There's always a little bit of a discrepancy there because they use options and futures to create the inverse or the leveraged component. So they don't perform exactly to the index. Here's the 15-minute chart for the SPY for this week. You can see we came out of the gate on Monday right here, and we had high signal walking up the upper Bollinger Band here. So again, when you recognize good signal to noise ratio on anything, index or stock, make sure that you respect that and don't get carried away fading, because you can do some damage to your account when you stubbornly add to positions or don't recognize the trend. So it's where we came from, but it's also how it's behaving in relationship to moving averages and in relationship to the VWAP. Make sure you look at different time frames. Good to have a tighter perspective like a 5-minute, but also good to push yourself back for the 15-minute and the 1 hour and just make sure that you're getting the full perspective. We did hit a peak here on Wednesday, and it started to falter a little bit, and then Thursday we followed through to the downside with a down open, filled the gap, and then sold off from that point to give almost 2/3 of the move back of what it had done in the first 3 days of the week. And then Friday here, we mentioned, was an inside day, trading inside the range of the previous day, ending on a down note, which is probably why you had the defensive issues perform a bit better, just because we sold off right into the close. So that was our 15 minutes for the week of the SPY. Now I want to bring out the SPY RSP ratio. So we've got the SPY is a market weighted ETF, market cap weighted ETF, and RSP is equal weight. So equal weight tends to favor the mid cap spectrum rather than just the largest market caps. And so it's a good thing to look at. We did look at it in last Saturday's podcast as well, but I pulled it back a little bit further. So this is now a full year plus a little bit. And you can see that we're starting to taper off. What does that mean? That means that the broader market, especially the mid caps, are starting to get more traction. Maybe it's because of how things have rallied. They're saying me too, and some of that excess performance that we've seen from the largest cap stocks is like, well, they've already had their run. They're starting to stabilize, maybe pull back a little bit, and the other market caps can do a little bit better. I like to also look at it through the lens of value versus growth. So IVE is the value and IVW is the growth. And there are various other ETFs to do this with. I really recommend taking that opportunity. You can go to TradingView. You can, look at it on the daily, even without a subscription. You can look at daily charts and create your ratios so that you can look at things based on relationships. So what is this saying to us? Well, in August through December of last year, that we kind of hit our biggest down point around October the 13th with the CPI numbers. And even before that, value was starting to outperform growth and had, still held up pretty well for the year. Going right into the end of the year, there was some tax loss selling on Tesla and other tech stocks and discretionary. And so they still stayed under pressure for December, and value was able to rally. But look, as we came right into the new year, what happened? They started to buy back, and the January effect took place, started to buy back those beaten down stocks, especially the ones that they had taken tax loss selling, and value started to underperform growth. And that's been the case all the way until we started to come into July. And now we're starting to see signs of life again in the value area. So what I'm seeing from kind of reading the economic tea leaves here is that the rally has spread out to a broader, category. We're seeing the mid caps and the small caps that have lagged start to pick up a little bit. We've seen some of the defensive areas start to pick up a little bit. We're seeing maybe a little bit of the value area start to pick up a little bit. So let's keep that in mind as we go forward. Very different season than what we've experienced, especially since the banking crisis and then the AI tailwinds and things like that. So we're kind of getting long in the tooth on that, and we're starting to change a little bit. So I really wanted to point that out. Now here's with the Qs versus IWM. Same thing. Since March, the Qs have just dominated over the small cap. So again, this would be the large cap as they were before the software rebalancing, really outperforming. And then as we've gotten into July here, the announcement of the rebalance and the subsequent completion of it on Friday. So the Qs have been tapering off a little bit in relationship to IWM, the small caps. There is an argument for this to continue. So again, when you put everything together that we've just been through and look at that broader market, look at the little bit more defensive, doesn't mean the market has to pull back, doesn't mean it has to go down, because we went through the seasonality. It's still looking strong for the last 5 days of July. And that's in keeping with the monthly expectation. It's in keeping with probably with the FOMC, things are already baked in. Doesn't mean that they won't say something in the Q&A period that can spook the market. I'm not saying that, but things are kind of baked in. The rally has got really no reason to completely stop. It's spread out to the broader market. It's spread out to a little bit more defensive things. So let's use that in our trading as best we can. Economic calendar.
Yeah, so Monday we have a little S&P flash manufacturing and services PMI. That number is the Purchasers Managing Index Survey. So it's a kind of an early indicator of what the final PMI is going to be. So we'll get some insight there. Again, that's how the economy is doing. Then on Tuesday, we have a little housing data, Case-Shiller Home Index. And then Wednesday, new home sales. So home prices are theme and sales. And Wednesday is the big report. It's the FOMC decision. And then Fed Chair Powell is going to have a press conference after. So that's the key event for the week. And then Thursday, there's a little more data on jobs, durable goods, again, pending home sales. And then Friday is PCE, personal expenditures. So again, more economic data as to how the economy is holding up. But the key thing is Wednesday, we have that FOMC number.
And, prior to this, the sentiment that's kind of been driving things has been economic reports have really kind of supported the soft landing approach. And we know that the Fed has, this hike on the books here for July, and then possibly one more for the year. Unless anything changes, that's what's been expected. That's what's been supporting the rally. And we kind of need to still lean on that and go with it, unless we get new information from the Fed on Wednesday, or perhaps one of these other reports that flies in the face of that. So we're still in earnings season. So what symbols are notable this week here?
Yeah, there's still a lot of earnings out there. Monday, we've got like Cleveland Cliffs, Domino's Pizza, NXP, semiconductors. But the big one's Tuesday. We've got Alphabet and Microsoft both on Tuesday. And then, there's just lots. You have to cross-check your symbols this week quite a bit. Lots on Tuesday and Wednesday. Thursday, Amazon. So those big ones, Google, Microsoft, and Amazon. So three of those, like what do they call them, Magical Seven or something?
Magnificent Seven.
Magnificent, yeah. Magical, magnificent, okay. Either way. So half of those basically reporting this week.
Yeah, no, those are big names, and they can be drivers. So we got two before and Amazon afterwards. And it can set the stage. Sometimes, the Thursday after the Fed announcement can be the hangover day, even if we have a rally on Wednesday, like after, maybe everything goes according to plan, and maybe the tone of the Q&A period is still kind of, dovish with a little bit of warnings about, hey, well, we're going to be data dependent and all that. But it doesn't mean that Thursday automatically has to be up. It could be a down day. The backdrop from Tuesday to the end of the month is still positive. The last day of the month not as strong as the 5-day seasonality. We have that here to show. So this is the last 5 days, last 3 days. So again, all of those windows are strong, not as strong as the mid-month. And the mid-month really kicked in on the 9th and 10th business day. Remember, Dave, like we sort of Google and everything kind of kicked in right away. And so that was really front end loaded. And then we drifted off on Thursday and Friday. Friday expiration went according to what we thought, be a little bit softer. And what we factored in the symbols that were for Friday, and normally seasonality does pretty good, but there was some of the symbols there weren't performing as well on this Friday. Like nothing to write home to mom about on the actual symbols themselves. But the day went according to plan here. And I just want to run through a couple things. The streaks, remember your reports. So this is again from the close of Friday to the close 3 days later. Is there anything trending up that fits into some of the things that we showed you on the 5-day window? Because the 5-day window starts on Tuesday. So is anything agreeing with that on the trending upside, trending downside? What about the bullish reversals? Like Nvidia, Trade Desk, Snowflake. 3 days down in a row, 4 days down for Trade Desk. Potential reversal here. You can see the odds and the average performance expectations. And then on the bearish reversals, anything leap out at you that way. We had a Walgreen Boots Alliance probably did pretty good last week. It's up 4 days in a row. We remember that healthcare came in pretty strong for the week. Maybe that'll pull back a little bit this week. So look through this and see if you can pair anything off, if you can get some complementary arguments from any of the other screens. RSI, same thing. I really like this bullish reversal side, looking for things that have been discounted that may pop up over the next period of time. So you've got trade desks showing up here as well. Got AMD. Now we had some kind of upsets in the semiconductor space there. There was kind of some interesting, change from the weeks before. So maybe there'll be some for NVIDIA and AMD. Maybe there'll be something coming back into favor there. So watch for bullish reversals and also bearish reversals. Probably stronger arguments than just simply trending up or trending down. But anyway, you can look through the list. We also have Bollinger Bands. Now, this is for a 10-day return. So these other two screens here are 3-day returns, and this one is a 10-day. So that covers 5-day window plus, and there are some probably complementary stuff in the bullish reversals. I see a conflict here with Snowflake on this trending down over the 10 days versus Snowflake showing up on which one was it here? On the bullish reversal. So a little bit of conflict there. And you can get that. This is a 10-day perspective as well. So it might actually rally a little bit in the first few days of the 10 days, which would agree with the 3-day perspective, and then start to turn over. So that's a possibility. But I like the dashboards to have a few things pop out at you that you might not have particularly paid attention to. It sure beats going and flipping through, hundreds of charts to try to find opportunity when you can get something leaping off the page here and then go and you can check it out on a chart. All right. I think that covers it. Anything else, Dave?
That's it.
All right. Well, everyone, thanks for listening, and have a good trading week next week and a good rest of the weekend. All right.
Good luck.